we need to talk about cash, specifically the obsession with holding it in the UK. With rumours circulating that in the spring statement there's going to be an announcement that the cash ISA annual allowance is going to be reduced from 20k to 4k. So this is the amount that you can invest per year tax-free. Now, personally, I don't think this is going to happen. I think the government has deliberately leaked this to gauge the reaction from the British public. I also think it'd be a pretty big political own goal. And there's no guarantee that it would actually work. So the idea that they want to encourage people to invest more rather than just hold their money as cash. But there's no guarantee that people would even move their money, because I think the purpose or the reason that people are holding their cash is not specifically because of the ISA. It's because of their risk appetite. And there's also no guarantee that people would actually invest in British businesses. If they were investing, they could invest in whatever they like. But I don't want to get too much into the politics of it. This was more about discussing, are we holding too much cash? Have we got a fear of investing? Should we be investing more? And what can we do? And I'm going to run through a few different scenarios. I really want to stress that this is just my personal opinion and this is not financial advice. The first thing I think we need to think about is, what are we actually holding that cash for? And this is the few scenarios I want to run through. So I think the most obvious one, first off, is holding cash for emergencies, right? You don't want your money to be invested in the stock market, which can obviously go up and down. It can be volatile. You want to have that security of knowing that that cash is always going to be there. And if you can get some interest in return, then obviously that's a bonus. I think we've got to think about, how much cash do we actually need? I think if you think about what an emergency fund would look like, so say, for example, you were to lose your job, you lose your income, or you had a medical expense or some form of emergency. You had an issue with your house and you needed to get something fixed or repaired, car breaks down, that kind of thing. I think you need to come up with a figure in your head about what that looks like. So say we do 6 months of living expenses. If you estimate you need about £3,000 a month to live off, well then 6 months is obviously 18,000. And if you're then saving more than that, I think it's important to ask yourself, why are we saving more than that? Why are we not putting our money to work in the stock market? And if there's another reason that we could be saving that money for. Another reason I think is, if you've obviously got a big purchase coming up, if you're looking to purchase a vehicle or a house, clearly you want to know that you've got that money ready to deploy. You don't want that to be obviously changing on a daily basis in the stock market. With this, I think it's important to note that you can transfer a stocks and shares ISA into a cash ISA. So say you've got long-term investments that you've built up and you get to the point where you're like, right, I'm going to put this as a deposit on a house. Well, you can transfer from your stocks and shares ISA to your cash ISA. It doesn't come out of the wrapper. So the annual allowances don't affect this. So if you've built up that investments, transfer it to cash. Say, you want to buy a house within 2 years. That would make a little bit more sense, right? Because then you want to secure the gains that you've made in the stock market, hold that as cash. And obviously you can deploy that when you're ready. The other part is, if you're getting close to retirement or you're later on in life and your time horizon is obviously a little bit shorter, you want to secure your money, then obviously holding a little bit more cash also makes sense. That same point still applies. So if you've obviously built up investments over a long investing career, for example, you can still transfer that towards cash. Remember, this change, if this change even comes into effect, is only affecting the amount that you can put into a cash ISA. So it's not affecting the money you already have in that account. It's just affecting the amount that you can put in. So I think it's important to make the point of, why is it important that we need to be investing? Why is it such an issue of holding too much cash? And there's a saying that goes, there's a risk of losing money investing in the stock market, but there's a guaranteed way of losing money, and that's holding cash. And this is all around the point of inflation and how that erodes our purchasing power. So if you're investing into the stock market, on average, right, and we can't always use past returns, but these do go back a long time. If you invested in the global stock market or the S&P 500, which tracks the American market, one of the most popular index funds, you're looking on average about 9-10%. Now, it's very rare that you do actually get 9-10% per year. You're going to get some years that are going to be 20+%. You're going to get some years that are going to be 5%. Obviously, you're going to get negative years as well. This is on average. So again, it's very much a long-term play, but that's the kind of return that you're looking at. Generally, that's always going to beat inflation. Of course, there's going to be years where it doesn't beat inflation, but over the long run, you're going to be good. If you're getting interest on your cash, you're getting it in and around 3 or 4%. And obviously that's going to vary depending on what central banks put their base rate as. And obviously it gets worse if you're holding cash in current accounts, which a lot of people do, and they're getting less than 1% interest rate. And over the long run, that's just been continually being eroded by inflation. So I think it's all about having a balanced approach, not having too much money in cash, not having too much money in the stock market. But remember, there's other asset classes that we can utilize as well. So when we think about investing in the stock market, we think equities, we think tech stocks, high risk assets, right? But there's other things that we can utilize. So whether it's investing in commodities like gold or oil, whether it's utilizing bonds. So this could be government bonds, essentially government debt, and they'll pay you an interest rate for you loaning that money to them. And this can be quite useful because generally you'll tend to get a little bit more than you would on a savings account, but you still have that added security because it's essentially obviously backed by the government. Another interesting place to look at is premium bonds. So you can invest up to £50,000 into premium bonds. They're backed by the government, and essentially it's a little bit like a lottery, but on average you get around 3, 4, 5%. So similar to what you would get in an interest rate in holding that in a cash ISA, for example. It's all tax-free. So it works very, very similar. You're going to get a similar rate, and you can put up to £50,000 in, which for most people is going to be more than enough for 6 months living expenses. So remember, you've still got that to utilize as well. It's just a case of asking yourself, what am I holding this cash for? If there's a purchase coming up, am I holding this for security, for emergency fund? And if it's an excessive amount that is over what you think you really need, you don't necessarily need to think, oh, I need to go and buy a load of equities. Like I said, there's loads of different asset classes you can use. And if you do want to go down the equity route, you don't have to pick single stocks. You can pick really simple. You can go with like a global index fund. So you can buy an ETF that's going to track an index fund that is essentially just going to track the global stock market. Hold it for the long run. When you're ready to transfer that to cash, when you're ready to buy something, you can transfer that within the ISA and you're good to go. But like I said, this is just my personal opinion. And obviously everyone's specific circumstances are unique to them. And also, I don't think this is even going to happen in terms of the change anyway. I mean, it could do. The spring statement is on March 26th, I believe. So you might be watching this video after it's come out and there might have been uproar and it might have all changed. But that's just my opinion. I think it's an interesting point to discuss and something you should just be aware of. You don't need to go out and make drastic decisions. I think you just need to be aware of where you're holding your money and are you getting the best return for that percentage of your portfolio. Thanks for watching, guys. I'll catch you tomorrow.